Welcome to Insights Over Coffee, the podcast where we cut through the jargon and look at what really drives markets and investing. I'm your host, Sahhar Saleh, and today we're talking about a quiet giant that affects currencies, stocks, and economies everywhere: global yield curves. In our last podcast called Japan's Yield Curve Did the Unthinkable, we spoke extensively about how Japan's policy shift reverberated across markets. Today, we're extending that discussion beyond Japan to developed markets more broadly, looking at government debt and yield curves across the G10. The big question now: where are rates heading from here, both on the short end and the long end of the curve? The answer could shape everything from portfolio allocations to the stability of the global financial system. Today, we're joined again by Ilias El Bahraoui, a portfolio manager at Lake Geneva Investment Partners, to explore how these bond markets are evolving and what they might be telling us about the path ahead. And as always, stay tuned until the end of the episode for our segment, Signal or Noise, where our guests will weigh in on whether the recent moves in yields mark a structural shift or just another temporary market cycle. Now, before we begin, a quick disclaimer. This podcast is for informational purposes only. Nothing here should be taken as financial or investment advice. Please consult a licensed financial advisor before making any trading or investment decisions. So maybe to start, our first question is going to be, what do you think of the political pressure the Fed is under?
Hi, Sahar. Thanks for having me again. Yes, I think Fed Chair Jay Powell is in a hot seat. Nobody wants to be him right now, given quite a lot of attacks he's under. I think we can all agree to a great extent that monetary policy should not be driven by partisan objectives. Otherwise, you end up with a non-functioning central bank, and consequently investors losing confidence in the system. And actually, you can end up with pretty much the opposite effect of what the current administration wants, which is perhaps soaring rates. As a matter of fact, there was a precedent in the 70s under the Nixon era, where back then the White House was pressuring the Federal Reserve. The gentleman running the Fed back then was called Anthony Burns, and actually he, under the White House pressure, he went along with some of the policies the White House wanted to implement. And needless to say that the 70s were a pretty bad decade for a number of asset classes, and specifically for bonds. Inflation went from single digit to almost 15%. The consequence of that, at the end of the decade, rates had to be taken much higher. I think the terminal rate, late 70s or early 80s, ended up at 16%. Bond investors naturally lost money, not just because of the rise in yield, but also because of the inflation. So in real returns were quite bad during that decade. So I really get how credit is a stimulant, and when money is cheap or sometimes even free, like we had in the last 10 years, prices go up of a lot of asset classes. So bonds go up, equities go up, businesses do well, and there's a feel good vibe, generally speaking. However, given what we went through not that long ago with spiking inflation, given where we are at in the broader debt cycle, I think the Fed's cautiousness has been justified to a large extent, and cutting rates more than they should be could actually lead to a long-term bad consequences, even though the next 3-4 years would actually feel good. And unfortunately, and this is not just with the current US administration, a lot of the administration, their goal is whether a short-term goal is playing for re-election or but never a long-term plan.
Along with trying to lower rates, the current U.S. administration seems quite determined to bring down the fiscal deficit. How's that going so far?
Yes, the deficit is an issue in the U.S. Fiscal deficit is an issue. That burden is a problem. And also, what's even more problematic is the cost of servicing the debt burden, because the rates now are where they are, much higher than what they used to be 5-6 years ago. The cost of paying interest is actually pretty high and really waiting on a fiscal deficit. So if you look at some of the first moves the U.S. administration did, the incoming administration back in early this year, I can point to kind of a podcast that actually we discussed recently here internally, that was its podcast name is All In, and the current Secretary of Commerce was on it, and it was kind of explaining the plan to bring money to the U.S. Treasury. So one of the avenues was Doge back then. Elon Musk and President Trump were still good buddies, and basically Musk said that he's gonna raise at least $1 trillion out of Doge. Unfortunately, that didn't work out. It lasted a few months and it sort of died. The second avenue is tariffs. Tariffs are a tricky one. Indeed, if you look at the current figures, the amount of money generated from tariffs is, we can see, definitely starting to come in the US. However, the long-term effect of tariffs is yet to be seen, meaning we don't know yet who's going to be paying for tariffs, whether it's the US consumer, whether it is US businesses, or is it the foreign exporter, or maybe it's a combination of the three of them. Hence, we don't know how tariffs will affect inflation and how they will affect different economic factors. So probably it's too early to talk about tariffs, even though some of the money started coming in. Now, naturally, cutting rates will help, as we just mentioned previously. But yeah, I mean, this is, I guess, how the U.S. administration currently is trying to go about things.
Yeah, so despite the state intentions, the US administration has not managed to shrink the fiscal deficit.
We'll have to see. I think tariffs will help. The revenues from tariffs will help. But also we'll have to see how the term goes.
Time will tell.
Time will tell, indeed.
And what do you think the US leadership should do to lower the debt burden and fix the deficit without inflicting too much pain on the economy?
It is a very tough one to pull off without much pain, because probably we are at a point where fixing the issue easily is almost impossible at this stage. But broadly speaking, let me just put it this way. You have three ways, or three main ways to deal with the problem. Either rates come down tremendously, and actually cutting rates is at least 4 times more effective than anything else. But we just mentioned that's not cannot be the only way, because there can also be some unintended consequences to that long run. The other two would be raising taxes and cutting spending. The issue with these last two is it can be pretty painful. It can be pretty painful, especially for a category of population that's already struggling. And a lot of reports are out there that people interviewed off the record, U.S. representatives on both sides, by the way, and everybody keeps saying they agree on the fact that these methodologies would probably be the ones to adopt, but there's no way they can be, they kind of say that if I show this to my constituents, I'll be voted out.
It's painful but effective.
It's painful but effective. Now, effective to deal with this issue. Now, probably, I would say that a combination of the three would be perhaps the least painful one, which means a bipartisan, agreement or project whereby you raise taxes to a certain extent, you cut spending to a certain extent, and rates come down as well a bit. Maybe a combination of these three can actually work.
And what's ahead for rate markets given the current macro climate we are in?
That's the $1 million question. Okay, let me start with the short end of the curve, since they tend to be more sensitive to Fed policy. Currently, if you look at the market expectation, by the end of 2026, the terminal Fed funds should be around 300 basis points, which means about 125 basis points of cuts still priced in. By the way, we just had a 25 basis point in the last meeting. In the last meeting, the Fed was not necessarily very dovish, which a little bit disappointed the markets, by the way. So if we take the 2-year US yield, for instance, that actually touched 3.5% right before the meeting, it slightly rebounded. And I would say if you look at the 2-year US yield compared with the Fed funds rate, this spread between the two has been inverted for now almost 3 years. And this is one of the longest inversions that we've had since pretty much since we have data on these securities. So even though there have been a quick spread one above zero a few times, but for a very short amount of time, but has been mainly inverted in the last 3 years, which naturally says that investors were anticipating rate cuts. And so I think that anticipation is kind of priced in, quite given the current economic factors. If we have more incoming data, that might change. But currently, I think the 2 years is pretty much priced where it should be, because if we come back to a natural or a more normal curve where the Fed funds rate are below the 2 year. On average, historically, if you look at the positive moment of positive spread, the difference between the two of them has been around 50 to 75 basis points. So if you assume the terminal rate is 300 basis points, probably the 2 year should be between 3.5 and 375. Now, again, given what we know so far, now unemployment is becoming a little bit problematic in the US. The Fed is watching that. We'll have to see how further data is going to come in and how that those expectations will change. Now, when it comes to the longer end of the curve, and specifically the 30 year, which is much more sensitive to macro factors and also a part of the curve that the Fed cannot control it that well. Recently, it failed to go above 5.5% or 5.2%, and that would have been, if it would have done so, it would have been probably very problematic, just because 30 year bonds, 10-year bonds directly linked to to mortgages. So we actually rebounded off that level. We are currently a bit below 5, and actually the US 30-year bond has been one of the best performers among the G10 countries. I think the US 30 years pretty much flat on the year in terms of yield. It sits more or less at the same levels as at the end of 2024. However, in other countries such as Japan, UK, those yields are much higher compared to their close of the previous, say, end of 2024. So we'll have to see where we go from here. Now, I think there are some other vulnerable countries when it comes to the developed markets. Japan, we spoke about in the last podcast. It's a country that actually led the way for certain things, especially zero rate interest rate policy, quantitative easing. They dealt with that way before the US and Europe did after the global financial crisis. And we saw what happened in Japan. Basically, if you're a foreign investor or say a dollar-based investor and you invested in Japanese government bonds in the last 10 years, you lost half of your investment or half the value of your investment, and not because the bonds defaulted, it's purely because currency devaluation. So it kind of feels and seems like Japan is pretty ahead in that cycle, whereby the actions of the BOJ combined with some other things made actually bond investments in Japan a terrible investment, especially for foreigners. And we slowly see that actually the dollar is also losing ground, not only versus gold, for instance, but also versus some other currencies like the Swiss franc, like the Norwegian kroner, and versus the euro. So it will be interesting to see if this trend is going to continue. UK is also facing a lot of headwinds. Yields are quite high. France is in a political turmoil. We've been following France lately they have been having a hard time under the second term of Macron to have a functioning government. The spread between Germany and France has been widening. So there are a number of countries, especially with a high amount of debt, that are facing some serious issues. We'll have to see how this is going to play out.
In our previous podcast, when we spoke about Japanese yield bonds, we had a question whether the BOJ was planning on stepping in. Do we have an answer for that?
We don't have a definitive answer, but it feels like the BOJ is also trying to step out at the same time. Something that was actually on the news lately is that they have a large amount of ETFs holdings that they try to get out of. And at least for the time being, they try to reverse what they have been doing for decades, which is buying huge amounts of Japanese assets, including government bonds.
So I have a few questions concerning credit spread, and I'll ask them one by one. Why are spreads so tight right now?
I think that credit spreads are benefiting from a risk-on environment that has been around pretty much since the beginning of the year, except what happened in April this year, Liberation Day. Equity markets are most indices, or at least the major indices, that are at all-time high. The AI trade is still very alive. Both S&P and Nasdaq are doing very well this year, and Europe also. So basically, credit spreads are very correlated to risk-on environments, and it's kind of natural that they are at these levels, especially as credit markets have been quiet, the rate of default has been in check, and the equities offering this environment for credit spreads to be at these levels.
So the strong demand for yield is because investors are piling into credit because it looks more attractive relative to cash and equities.
Yes, and also the fact that the Fed is expected to cut rates is helping with this.
Are all risk priced in?
It is difficult to say. Generally speaking, markets can get ahead of themselves, and that's why you have these boom and bust bust scenario. Yeah, the reason you have also bubbles, etc. So not all risks are priced in, generally speaking. Currently, there are corners or segments of the market one can be worried about, and we were mentioning in a discussion not that long ago, private credit or private debt. This is something actually here at Lake Geneva we wrote about 2 years ago. Where we saw how much how much money went into the sector, specifically in the United States, and we believe actually that the sector received more money than it can handle. So naturally, you're gonna have money going into bad credit. We slowly starting to see cracks occurring in private markets. There are certain securities that we follow, typically BDCs, that are showing signs of weakness. Now we'll have to see if this is just a temporary or it can actually snowball into a bigger issue.
So, in terms of macro risk, if growth slows, default rise, or unemployment climbs, credit should reprice wider?
Generally, that happens indeed when these factors are occur.
And could there be trouble ahead?
There could be. There could be, especially if some of these segments, for example, we spoke about private credit, we didn't speak yet about crowding. Generally crises don't hit in the same place. We had what we had in the global financial crisis. Probably some of the risk moved to corners of the market where there's less oversight and the rest like regulation. So private markets is definitely one of them. If we go back again to private credit, it's a sector that never actually seen a crisis before, has never been tested before, and had an amazing run since 2008 for various reasons. The fact that the rates were extremely low for almost a decade, that helped a lot. But it is a sector that actually had returned almost as good returns as the S&P. Now that's one. Of course, what we've seen is the growth of multi-strategy hedge funds. There's definitely a phenomenon of crowding in certain strategies. A lot of these hedge funds, to a certain extent, also received more money than they can manage. We've seen it actually by these big institutions try to outsource capital, looking for hubs or for traders team where they can actually allocate money. So there's definitely a concentration of strategies, the same strategies being practiced by different shops, which has not been the case before. And to a certain extent, we see that how volatility hits when it hits. So what happened in April 2025, but more importantly, what happened over August 2024 last year when the BOJ and Japan triggered a sell-off and the unwinding of certain trades. The way the volatility and the VIX spiked intraday was something we have not seen since the global financial crisis, which kind of suggests that there are some underlying issues that slowly are brewing. And yeah, so just to mention these two, this is what comes to mind for now.
Well, thank you for that. Before we wrap up, it's time for our tradition here on the show, Signal or Noise. Here's how it works. I'll share a headline that's been making waves, and our guest will weigh in on whether it's a true market signal or just background noise. But first, a quick disclaimer. Everything shared in this segment is for informational purposes only and does not constitute investment advice. For any financial decisions, please consult with a licensed financial advisor. So the headline reads, Global bonds re-enter bull market as Fed easing bets rise. Is this a sign of a lasting shift in the global monetary conditions and renewed investor confidence, or are we simply witnessing a temporary rally fueled by market positioning?
It's an excellent question. It's undeniable that this year, if we just take this year alone, 2025, we had the right conditions for bond markets to do well. We had an extremely stable credit environment. As we just mentioned, credit spreads are extremely tight right now compared to their historical averages. We haven't had many sell-offs except Liberation Day in April, where naturally credit spreads widened and some segments of credit sold off. In conjunction, we also had rates, mainly in the United States, that actually came lower from their close of 2024. So if you look at most tenors, the 2-year, the 5-year, the 10-year, the rates currently are lower than at the beginning of the year. So that actually helped fuel not only high yield emerging debt, but also high grade corporates, government bonds, and most of the credit and fixed income indices are actually positive this year. And naturally, there is the fact that the Fed is the market's pricing in cuts has helped. Now, going forward, is this just a particular year, and we can again hit volatile markets just like we had in 2022, and to a certain extent, 23 and 24, at least when it comes to the rate market, it is possible. Again, it will depend on incoming data and how the Fed is going to react to them. Well, the Fed will carry out all those cuts or not. If the Fed cuts, will we stay in a growth environment where the risk-on mood will prevail? It really will depend. So the Fed cutting rates, that does not necessarily mean bond markets will do well. We'll have to see what else will happen in terms of in terms of the economy. If the Fed is cutting rates because the economy is plummeting, probably credit is not going to do fine.
And that's a wrap for today's episode of Insights Over Coffee. I hope this conversation with Ilias El Bahraoui gave you a sharper perspective on global bonds, how yield curves across the G10 reflect shifting economic realities, why they matter for risk and return, and what they might be signaling about the path of rates going forward. If you've enjoyed today's discussion, make sure to follow, subscribe, and share it with anyone who wants a deeper look into the forces shaping markets. We'll be back soon with more conversations on the strategies, dynamics, and ideas of defining the future of investing. Thanks for tuning in, and until next time.
Thank you, Sahar. Always a pleasure.
It's a pleasure to have you.